Okay, we're going to get started today by looking at the front page of Yahoo Finance. You can see that uh, the Santa Claus rally is being talked about on CNBC and a lot of the news outlets. Basically, the Santa Claus rally is at the end of every year. Let's look at okay, we're right here. Um, Santa Claus rally, usually the week of the Christmas, we have the stock market usually goes up, and we also have a follow-on. The week after is end of quarter window dressing, which we've marked as the last day of the quarter or last week of the quarter. So we have a lot of positioning, a lot of money managers that need to catch up to the S&P performance. So they're going to be buying a lot of the winners from this quarter. And that makes, in general, the stock market go up. It doesn't work every time, but um, sometimes it's a self-fulfilling prophecy. If you have everyone on TV talking about it and everyone knows that stocks usually go up around the end of the year, then you most likely have a good end of the year, but it doesn't work every time. Um, so what's coming up this week? We have next week. Next week, we have the Fed meeting, and there's going to be a decision on interest rates. That'll move the market one way or another. Um, a lot of times, the stock market will just be flat until that date because a lot of um, whether the stock market goes up or down is based on interest rates sometimes. We do have what's known as triple witching next Friday. So there's going to be a lot of volatility, and you just have to be ready for that. It's the expiration of options. It's a major expirations of options day. So we do have Christmas coming up. That is a holiday, and we have New Year's. So two holidays in a row. Um, one of my theories, well, a theory in the stock market is uh, stocks usually go up before holidays because people are in a good mood. So that is what we have for the big picture. Let's go back to Yahoo Finance. You can see we have a very interesting article here from research veteran Yardini ends 15-year tech bet with underweight Mag 7 call. Let's look at that. Um, Basically, Ed Yardini is an economist, and he basically has his own business where he gives advice. But in general, he he's been very bullish on the S&P and in the market in general for quite a long time, since at least 2010. And right now he says basically it doesn't make sense to overweight the Mag 7. He says our firm recommends market weighting of the two sectors by adding to overweights in financial and industrials and healthcare. So now let's look at our map describing this a little bit right here. This is the S&P sector PE valuations relative to history. So we've been saying for quite a while that these sectors that Ed Yardini are just talking about that have been out of favor are so much out of favor that Ed Yardini, after 15 years, recommends overweighting in these and underweighting in some of the more expensive parts of the market. So what we're going to see maybe, if Ed Yardini is right, is this part of the market doing better, the underperformers, and relative to history, and this sector is doing not so well. Um, okay, so but if you're invested we still have the tech stocks. They are growing individually. It's mm, it's okay. Right now, it's just his v- his his call that these sectors will outperform in the near term. Okay, so that's always good to keep that in mind, but you have to keep everything in mind whenever you're investing, and sometimes capital gains is something to keep in mind because if you sell stocks, then you have to pay taxes known as capital gains on those sales. So sometimes it's not as easy as Ed Yardini said, just get out of one sector into another. Um, so let's look at some more news stories. Trump says the Netflix deal to buy Warner Brothers could be a problem because of size. We'll look at Netflix this week because it's in the news. It went down a lot because it announced a takeover of Warner Brothers. And Netflix, a lot of times, whenever you have a stock acquiring another stock, then one company acquiring another company, then the acquiring company, Netflix, goes down and Warner Brothers, the acquiree, goes up. Um, so, so what we have here is we have Netflix going down. One of the biggest problems with this is Netflix doesn't have the money to pay for this. They're going to have to borrow money. So we're going to look at Netflix and see if it has um, any credence in that investment thesis. Um, they're becoming they're right now the largest streaming provider. YouTube is very close, actually, but they're trying to get even bigger. So we'll see if that happens. Now, let us look at the S&P 500. Okay, let's look at. Okay, you can see we're in a well-defined uptrend. When we look at the stochastics for the S&P, let's go back and look. You can see we're in a well-defined channel. We're right in the middle of our channel and we're overbought in a major way. And whenever we look at this overbought or oversold, um, when it's like this and it's overbought, it's not a good time to start buying. Um, Although we know we have a seasonality towards the end of the year, a good seasonality pattern. But right now we're just a little bit overbought. So let's look at all of the other sectors. And what we're keeping in mind is this section right here. We're overbought, 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 overbought. So almost every sector we're watching is overbought except for healthcare. It actually is a little bit oversold right now. And you can see healthcare is at the bottom end of its channel. So this healthcare is the only sector right now that's oversold and a good time to start accumulating stocks in that sector. Let's look at, okay, utilities actually are also in that same pattern. You can see that they're oversold and the bottom end of their trend line. So those inclined to buy utility stocks, I don't have any, but this is a good time to start buying utility. Let's look what else we can see from our stochastics. Okay, let's look at, all right, I think we've done enough of that. All right, so let's go look at our earnings reports coming out this coming week. This past week, there weren't that many um, important stocks reporting. Important meaning market moving stocks. A lot of these stocks are smaller, and they don't have a whole lot of effect on the stock market. This coming week, we have Oracle, we have Adobe, and Broadcom is probably the most important one of all these, Oracle and Broadcom, because that'll give you a hint of the spending on AI. Um, okay. So one interesting stock is Costco. Costco is it's in a downtrend. You can see, let's look at Costco, the actual stock. There it is. You can see it's in a major downtrend. Um, it's not a good idea to buy this stock. It's making lower highs, lower lows. Um, and it's also overvalued. It's only grown at 10%, but its PE ratio is 30, which is like a peg ratio of 4. It's very expensive. It's always traded in a very expensive compared to the stock market. Um, so it's very dangerous to buy a stock that has a high peg ratio because if it disappoints in any way in earnings, then it's a good chance of it correcting. Let's look at okay, let's look at some more of our notes. So Costco supposedly is going to, let me see, they're supposedly going to report on Thursday, so we'll see what they say. Um, Adobe's going to be reporting. We're going to see if AI is affecting their business at all, because if you can make quality media with ChatGPT and some of the new AI tools, why would you want to buy Photoshop? So so that this company might be in the process of being disrupted. And we have Oracle. They are spending a lot on AI, and the people that they are selling their goods to might not be able to pay for it. So they might be making more capacity than what the market needs. So if that happens and they get into a debt problem, Oracle Oracle has sold off a lot recently because of the fears of overspending. Um, and Broadcom is very um, important company because they're making customized chips for Alphabet and a lot of the hyperscalers. So that could be one we start watching um, on a regular basis. All right, so let's look at some of our statistics. We see S&P isn't up a whole lot, maybe 0.5% from last week. Um, we have improving momentum. We have 60% of the S&P 500 above the 200-day moving average, which is pretty decent. But a bullish market, we have over 70% above the 200-day moving average. We still have fear in the market. So right now, we're basically in neutral market, mixed or consolidating, where conditions are not strongly bearish or bullish. Okay, so let's look at our seasonality. Seasonality, December is usually a good month. Doesn't mean it is always a good month. If it was always a good month, we'd all be billionaires. But you can see we have a less volatility. This is the one of the lowest volatility months of the year, meaning it's not going to go up and down a whole lot, usually. All right, and let's look at the S&P 500 again. We can see that we're overbought right now. This might last until the end of the year for the Santa rally. But we are right in the middle of our trend line. So we very easily could correct down to the bottom part of our trend line or go to the top of our trend line. So there's no real buy or sell signal right now. Although we are overbought, so it's not a good time to buy. So let's look at well, the good thing about the S&P 500 right now is up. It's above all of the moving averages. You can see the 20-day exponential moving average. We have the 50-day, 100-day, 150-day, and the 200-day. So that is very positive for momentum and for the stock market to keep going up. Let's look at the 10-year Treasury. It's 4.14. So it's actually interest rates have gone up in the past week. So let me see. Okay. So interest rates have gone up. So we have to follow our chart of um, companies that are affected by higher interest rates. Um, so if we look at our higher interest, let's look. All right. So companies that are affected by higher interest rates, small cap companies, biotech companies, companies that need to borrow money, um, companies that are paying a dividend are going to be going down because if you have a guaranteed U.S. Treasury increasing its yield, then no one wants to buy some of the higher yielding stocks with risk of the stock being volatile. All right, so let's look at um, the price of oil. It is basically the same as last week. Um, we have inflation basically the same as last week. And the US dollar has been unchanged also. So we have a lot of our variables unchanged since last week. Gold price is about the same as last week also. Let's look at a chart of the dollar. The dollar is basically the sideways pattern since July. And it was going in a downtrend. So now what you have to keep in mind is the multinationals this past quarter had a bonus of they made more money when they repatriated money from overseas. But now it's going to be neutral for them because the dollar is going sideways and not going up, not going down. So there's no tailwind for the US dollar in companies' earnings report this coming quarter. All right, so let's look at the fear greed index. We are less fearful than last week. We've been extreme fear. Now we're almost tending towards neutral. So we are less fearful than before. So that our translation is start looking for things to buy. Whenever people are extremely greedy, then you want to take some profits off the table or don't buy. And you got to do the opposite of what people are doing in the stock market. When people are greedy, you sell. When people are fearful, you buy. That's kind of a Warren Buffett mentality. Be fearful when others are greedy and greedy when others are fearful. Okay. Okay, let's look at the AAII Individual Investor Survey. We see that the majority of amateur investors are bullish now. So our translation, bullish, is caution, take some profits off the table or don't buy. All right. So we have kind of the amateurs say, turning bullish. Um, the VIX is actually, we have fear leaving the market. VIX is at 15 this week. So that's really low. And um, so that is translation. People are not fearful and they're looking for a bull market. And um, but we are overbought right now, so we have to keep that in mind. Okay, so we do have fear still in the market in our emotional graph. So I've put the X right here in fear. Um, okay, let's look at the worst of first. Um, okay, from last year, we had the communications sector, IT, and consumer discretionary performing the best. This year, consumer discretionary is one of the worst. Um, But communication services, XLC, these are stocks like Facebook and Google. And IT is up 22%. So we still have these two sectors as the best sectors, the same as last year. And we have the next best sector is industrials, and we have healthcare actually at 11%, which isn't bad. And these sectors, the energy, consumer staples, and materials are still the bottom performers. So we'll keep an eye on that. Um, Ed Yardini was saying healthcare and financials, healthcare, and energy are stocks to look into or sectors to look into. All right, so let's look at, we already talked about this, valuations. All right, let's look at some of the stocks going up and down today, the market movers. We have Ulta Beauty. They had a good earnings report. Um, we have Warner Brothers Discovery. They're up. They're being taken over by Netflix. And a lot of times, whenever you have takeovers, the company being taken over goes up, and the company that is buying the company goes down. So we have Dollar Tree and Dollar General. These are some of the best performing stocks this year in the S&P. Why is that? Mm, they are definitely greatly affected by the tariffs. Just think, if Dollar Tree sells stuff for $1.25 and they have tariffs that are like 50%, they don't have much of a margin that they can make if they have to if they have to keep their prices at $1.25. But they managed, it seems like a lot of customers are paring back their spending, so they end up going to Dollar Tree, Walmart, and Dollar General. So Walmart is also outperforming this year. So let's look at the top decliners. We have Paramount Skydance. Hmm. Maybe whenever Netflix is taking over Warner Brother Discovery, that's going to make it very hard for Paramount to compete against them. That's why they're down. Let me see. Vistra Corp, they make products for the AI data center. Um, Robinhood, this is one of the best performing stocks this year. Robinhood is maybe that's profit taking. We have, okay, so I don't see any other themes here. Okay, that was a good little exercise. Okay, so we know from our 10-year chart that the interest rates are going up. So the yields are going up. So this is our chart. That's positive for large cap, large tech stocks, financials, insurers. Negative for small caps, high yielding, home builders. Let's see if that's what's happening today. We have retail, semiconductors, technology. Okay, so it's positive for technology, financials, insurance. Let's see if that happened. Yes, technology and financials. Yes, right here, financials, consumers. Okay. Hmm. And it's negative for, what's our negative for small caps, any company needing to borrow money. So let's look at the ones going down the most. Metals and mining, utilities. Sorry about that. Okay, so small caps, high yielding, companies that need to borrow money. Let's see if these companies that are on our, these kind of companies need to borrow money. Home construction. Um, as the interest rates go up, the demand for housing goes down. So that explains why housing stocks are down. Biotech, they need to borrow money because most of them are unprofitable. So that makes sense. Healthcare pay a dividend. So as the interest rates go up for the 10-year, there's a lack of demand for companies that have pay high dividends. Let's look at, was a good exercise. Let's look at day analysis picks from the beginning of the year. Cisco continues to outperform, and the large cap bank ETF is doing good. Um, he currently says cash is a good thing to have right now. I'm not sure why, but cash has done really bad this year. From his pick at the beginning of the year, it's super underperforming the S&P 500. Um, I picked out some interesting charts. One is the XLV. Right now, the healthcare has been out of favor for at least the last week or two. But you can see we're at a bottom end of the trading range of our channel, and we're oversold. So this might be a time you want to look at buying some healthcare stocks, just like Ed Yardini said. And let's look at, yeah, I mentioned this before. The utilities were at the bottom end of our trading range, and we're oversold. And Altria, as the interest rates for the 10-year continue to go up in yield, the demand for high yielding investments such as Altria Group, they pay a 7% dividend. Um, demand for those go down. So as the interest rates continue to go down, the demand for a high yielding investment should go up. So we'll see if that happens. I thought it'd be interesting to look at Altria. You can see that they're kind of in a trading range. You see that it's kind of sideways. We're at the bottom end of that trading range, and it has a very low PE ratio, is 11. Um, but they have a dividend of 7.31%. So there's something called a rule of 72. If you divide 72 by the yield, you get the number of years it takes to double your investment. So I actually bought Altria quite a while ago. I've already doubled my money. So you have to wait 10 years in this scenario to double your money. Um, and this is actually, if you held this, if you bought this stock um, and held it, it's been one of the best performing stocks in the stock market going back to like the 60s because there was a lot of spin-offs. I mean, they spun off Kraft Foods and a couple other companies, and they pay a lot of dividends. So, but right now, um, they're making a transition in their business from smoke-oriented products to smokeless. So there's a little question if they can continue their to make money that way. All right, let's look at Apple. You can see that it's in an uptrend. It's overbought right now. It's halfway between its trend lines. So it's not a buy or sell. It's kind of don't buy. Let's look at this one. This is Walmart. We saw the $2 General Dollar Tree stocks in the top holdings. Now look at this. It's Walmart is actually super outperforming. They're overbought. It seems like a lot of people are gravitating towards Walmart from all types of wealthy people, middle class people, and lower class people are all gravitating towards Walmart because they have a good good price on things. And we have inflation and people are trying to make ends meet. So, but they are compared to history pretty expensive. They have a PE ratio of like 30, which is very expensive. Very similar to Costco. But let's look at the video. You can see that it's totally out of favor right now. It's hugging its 100-day moving average. You can see that green line. Um, it's above its 200-day and 150-day moving averages. So it's right at the support level for its moving averages and at the bottom end of its range. So, and it's out of favor right now. So we'll keep an eye on that and see if it bounces off of that and goes up to here next. All right, let's look at another one. This is Eli Lilly. We saw the XLF. Let's go back at the look at the XLF. Okay, XLV, I mean. You can see this XLV. A lot of these drug stocks are out of favor right now for the past week, and they've been going down. They're oversold. So this is mirroring the same Eli Lilly. Let's look at Eli Lilly. You can see it's like the same chart. So you can see it's oversold also. Eli Lilly has had a really good earnings report, and they're selling a lot of their weight loss drug. And they're trading around a PEG ratio of 1, which is pretty decent. Um, let's look at T-Mobile. You can see it's out of favor right now. Um, it's oversold, and it's at the bottom end of its trading range. So it's actually taking market share from the other phone companies. So they're like a growth company, but they're kind of just sitting here out of favor for a little bit. Let's look at some of the stock screens for this week. Some of the more interesting ones is I see Netflix is in our um, in our stock screen. We have Uber, which is a little bit, it seems like it's fairly valued, and Micron is 5 times undervalued. So I thought it'd be interesting to look at Netflix. We haven't looked at that for a while. The PEG ratio, according to Fidelity, is 1.8, meaning Fidelity thinks it's about 1.8 times overvalued. So if you divide the current price stock by 1.8, you'll get the fair value of the stock. So I thought it'd be interesting to look at it, seeing that's in the news. They've announced an acquisition of Warner Brothers, Discovery. So that adds a lot of debt to this company's balance sheet, which isn't that great. Let's look at Netflix. You can see that the pattern has been down since at least July. You can see it's in a downward pattern, and we're at the bottom end of its range right now, and we're oversold. And I thought it'd be interesting whenever we see this major down 3% on acquisition news. If the acquisition doesn't happen, the stock will make up that loss from this day that they announced the acquisition. So let me see. Let's look at their earnings estimates. You can see that they're growing in like 20%. This year to next year is 28%, then 27% the next year, and then 21% the year after. That doesn't take in effect any of this Warner Brother Discovery HBO Max acquisition. Um, so let's say they're growing at 28%, and their PE ratio right now is 37, which is pretty high. The PEG ratio is 1.3, which is 32% overvalued. So that matches Yahoo Finance's 1.29 PEG ratio. So, but you can see the profit margin and operating margin are pretty decent. That's double what we're looking for. And the return on equity is 42, which is four times what we're looking for. The total cash, here's the biggest problem right now. They have around 10 billion in debt now, if they buy a $72 billion company, that makes their total debt um, mm, 82 billion. And that's still kind of it's reasonable compared to a market cap of 424. But it's that's why the stock market has sold off, I think, and it sold this stock off in the past day. So they're borrowing 72 billion, and that might not happen. Trump says the Netflix deal to buy Warner Brothers could be a problem because of size antitrust issues. So we'll see what happens. So it's overvalued right now. And with the news, it might go down more. And it's fairly valued if you divide the current price by 1.3. So when it gets down to that point, we might want to look at it. Let's look at what CFRA says about Netflix. They have it as a buy, the price target of 100 or the price target of 130. So they say we maintain a buy rating, believing Netflix extends global competitive advantage versus U.S. network providers. Key catalysts include ad pay plans and advertising expected material, plus live events driving engagement. The Warner Bros. Discovery acquisition enhances market power and content depth. Netflix achieved record quarterly TV view share in largest markets with compelling content and successful live events, like a boxing match attracting a lot of viewers. Okay. So CFRA says that their fair value is 95, which is 4% above. So they're 4.7% overvalued according to CFRA. That tells us it's very, very close to fair value according to CFRA. The interesting thing about their earnings, you can see that it's a little bit inconsistent, but lately they've been growing. It's I like to see a consistent 10% or 20% growth rate over time. And you can see it's off and on. So you get 60, 112, and then he went down to $1 in 2022. So it's close to what we're looking for in this earnings. Okay, let's look at okay, CFRA sometimes happen whenever you have a major event for a stock, they make a comment on it. They said their definitive agreement to acquire this company approval following the separation into publicly traded company. Hold on. It's expected to close in a year, and it's likely to get DOJ antitrust and other federal regulatory reviews. And there's a significant breakup fee if Netflix does not go through with the acquisition. So that's a major reason why the stock could be going down near term. There's a good chance that this merger is not going to happen. So they might have to pay 2 to 3 billion in breakup fees if it doesn't go through. So they believe the cost synergies will most likely be in programming and production costs as well as other distribution capacities. Okay. All right. So that was a good note. Let's look at what Morningstar says. They say that it's 30% overvalued and its fair value is 77. So they think they've overpaid for the company. They say high merger price alters shareholder value for both. So they didn't like that deal. They said they are paying 25 times estimated earnings for this Warner Brothers, and regulatory approval is highly uncertain. So they didn't like that. The bottom line, they say, we think regulatory approval is a toss-up, 50-50. We anticipate raising our fair value estimate to around for Warner Discovery to around 25 to 20 to reflect the 50-50 chance of approval. Those odds should lead us to modestly reduce the fair value estimate and leaving the shares substantially overvalued. Okay, so this gives us an overview that the stock is overvalued. There's a chance that the stock will sell off like 30%. And if that happens, that's a good stock to buy for like a long-term hold. Here's another article. It says two semiconductor stocks to buy hand over fist in 2026. Um, this is one of the favorite sayings of the Motley Fool: buy the stock hand over fist. Um, so we'll look at it. They said NVIDIA and Corning are two stocks to look at. We've been following NVIDIA, so I'm not going to go into that. But they did say Corning and Micron are two of those companies. Here's why investors might want to buy a few shares of each of them in 2026. Okay, the case for Micron. Micron is one of the top suppliers of memory and storage chips. For AI workloads in the data center, high bandwidth memory stores information in a relative state when GPU needs it. Okay, so they make memory for the AI infrastructure. In Corning, they make the wires for AI data centers. So they supply some of the world's best fiber optic cables. They've also make Corning also makes the Apple's iPhone since 2007. They make the iPhone glass. Um, Corning is up 83% this year because of this AI fiber optic cables. Let's look at Corning. We've already looked at Micron. We know Micron's a good deal, and we went over it a couple times. Let's look at Corning. Okay, Corning, I looked at their earnings estimates, and they're growing 20% from last year to this year, 15% this year to next year, and then 8%. So let's be optimistic and say that they're growing at 15% just like this year to next year. Their PE ratio is 29, which is pretty high. And you divide 29 by 15 and you get a PEG ratio of 2. So they're 2 times overvalued and their earnings are decelerating. Jim Cramer really likes this stock also. Um, so their operating margin is decent. That's right, our minimum. Return on equity is our minimum and acceptable. They have around 8 billion in debt. So, or 7.5 billion in debt out of a market cap of 72, which is that was okay. Um, all right. So what does C4A say about it? They have it as a buy. They say our buy recommendation reflects Corning's transformation into a Gen I infrastructure enabler. Optical communications explosive growth represents a structural shift. Apple's commitment for iPhone watch glass provides multi-year visibility. They've launched the largest solar facility, expecting to triple run rates. Um, okay, so they have a lot of AI um, um, profits. So we already looked at that. Let's look at the fair value. CFRA thinks the fair value is $65 and they're overvalued by 23.95%. Okay, Jim Cramer, I don't think I like this one. It looks like it's a little bit overvalued. And let's look at their earnings over time. It's very inconsistent. You can see that we have 0, 3, negative, 1, 1, 50 cents. Okay, so that's another one that's very inconsistent. It's not growing 10% a year. So I think this is overvalued. Um, let's look at what Morningstar says. They said the fair value is 60, so they think it's 38% overvalued with a price to fair value of 1.38. Um, we raise our valuation in AI forecast, but struggle to agree with the market. They think it's overvalued. Let me see. The revenue growth continues to be driven by artificial intelligence infrastructure demand. This company will go up and down with the AI infrastructure stocks. So as they go up and down, you might see them go down to their fair value of 60. And I think the bottom line here is it's overvalued. When it gets down to 60, it could be a good time to start acquiring some of this. All right. So that's all I have for today. I hope you enjoyed that talk, and I hope you have a good week of investing. All right. Well, I'll see you next time.